Okay, you're welcome to today's lesson. In today's lesson, we are going to look at a kind of a subset of control accounts. In our previous videos, we have looked at what control account is all about. We've defined what control account is all about. We've looked at control account as a memorandum account, an account that looks at the balances of our debtors and our creditors. But in today's lesson, we just want to focus on how to prepare sales ledger control account. We want to focus our attention on how to prepare sales ledger control account. All the necessary definitions that we need to know about our control account has been taken care of in our previous videos. So I encourage you to go and search for control account, the definition of control account, the advantages of control account. We also look at the division of control account, and we also explain the concept of contra entry. But for today, we are not going through all of that. We are going to now focus on how students will now be able to prepare sales ledger control account. Now, before we move forward, we want to quickly take what I call lesson objective. Lesson objective is always very, very important because it is like the guide. It is like the compass of the journey. You embark on a journey without a compass, journey to an unknown destination, without maybe a direction or a Google map, is going to be very difficult. So in our lesson today, our Google map for this lesson is what we call the lesson objective. They are just four. Number one, we are going to define what we call sales ledger control account. If you are asked to define, what do you understand by the word sales ledger or sales ledger control account? Number two, we are going to state the rules of sales ledger control account. There are rules that guide the preparation. We are going to look at it. Number three, we are going to state possible transaction on both debit and the credit side of the sales ledger control account. I know that the problem or the challenges of students when they want to prepare account, they will be asking you, please sir, what and what should be on the debit side? What and what will be on the credit side? What if the examiner decide to do this? How do I now know what should be debited and what should be credited? And that's what we are going to look at. We're going to check what should be on the debit side of the sales ledger account and what should be on the credit side of the sales ledger account. And we have actually taken time to look at the possible transaction. We've gone through a whole lot of yes questions in JAM, in WAEC, in NECO, in any accounting related exams, and we have seen repeated transactions. So we've been able to pick out or extract possible transactions that must always be on the debit side and must always be on the credit side. So by the time we get to that point, I will encourage students to master it, be rooted and be grounded on it, so that by the time questions comes up, you'll be able to identify that this one is what should be on the debit side and this one is what should be on the credit side. And the last on our objective is we are going to solve related problems. By the time we are done, we are now going to check ourselves by trying to solve problems. Now let's take the journey further. The definition of sales ledger control account. What is sales ledger control account? Now, sales ledger control account is simply the control account for sales ledger. It's sounding like you are just repeating what you have said in the definition. Sales ledger control account is simply the control account for sales ledger. As funny as that may sound, and as simple as that may also sound, that is the best way we can define it. Because the account is basically for sales ledger. And there's no better way we can explain that sales ledger control account is exclusively for sales ledger. Now, I added that it can be referred to as total debtors control account, trade receivable account, or account receivable. As we go further in our journey, you will appreciate the definition. Let's now look at the rule. The rule of sales ledger control account if I want to prepare sales ledger account, what is the rule? You know, students should not toil with what we call principles, what we call conventions, what we call concepts, what we call rule. You see, their life is guided by principle. Life is guided by rule, conventions. If you must go far in anything you are doing, you must not toil with the principles that govern whatever you are doing. Once the principle is violated, once the rule is broken, once the conventions are compromised, then you are going to get a wrong result. There's no two ways about it. And over the years, students have been crying after exams because they don't want to observe certain rules. You enter the examination hall, you are given a question, all of a sudden, you couldn't remember the rule that governs the particular question. It becomes a problem. But I want to believe that with the simple nature of this rule, you are going to remember it. Now, I said the rule of sales ledger control account states that every transaction that will increase the indebtedness of the customers or debtors should be debited, while the reverse should be credited. Very simple rule. Every transaction that will increase the indebtedness of the customers or the debtors should be debited, while the reverse should be credited. Another very important question, sir. Who is a debtor? A debtor is somebody that comes to the business to buy without money. A debtor is somebody that comes to the business without exchanging something of value. A debtor is somebody that comes to the business, enjoy the services of the business without making payment. That person is a debtor. So, whenever you open an account in the name of that debtor, there are transactions that will increase what the person is owing, and there are transactions that will decrease or reduce what he is owing. So what this rule is saying is that when you open your account, every transaction that will increase whatever this person is owing should be debited. And every transaction that will reduce what this person is owing should be what? Credited. The next question is, how do I know items that will increase what is owing, and how do I know items that will reduce what is owing? That is why you have this lesson. Let's move on. Now look at it. Very interesting. We have the debit side of the sales ledger control account. Now this is how the debit side look like. I said possible transaction that will increase the indebtedness of the customers include number one, credit sales. Now, there are transactions that tend to increase what your debtors are owing you. Number one, credit sales. Mr. Peterson came last week and bought Indomie, 5 cartons of Indomie on credit. We're already counting 50,000 on Mr. Peterson's head. Now, this week again, Mr. Peterson has come to buy another one. It has increased what Mr. Peterson is owing us. He bought 5 cartons. He was owing 50,000. This week, he comes to buy 3 packets and 3 cartons. To make it, that's about 80,000 now. We are selling one for 10,000. So at this point, every time you carry out credit sales, it will always increase your debtors' indebtedness. Number two, debit note issued. What is debit note? Debit note is always issued for undercharge. A debit note is a note that is issued for undercharge. Imagine Peterson actually came and what he took was 10 cartons of Indomie, and what we charged him was 8 cartons. Imagine, he actually took 10, but when we were now trying to package everything, we miscounted or we undercounted, and then what we now counted and put on the invoice is 8. Meanwhile, it was 10 that he took. Now, after like 2 days, we now realize, by the time we are now taking stock, we now realize that we made mistake, or probably we check the camera to see that, oh, it was actually 10 that we gave him, or possibly on his own, he called back to say, sorry, when I got to my shop, I saw 10 carton. At that point, a note will be issued. Remember, what we have in our record is 8 carton. Let's assume it was 80,000. Now we have issued debit note to him, telling him that, see, 2 carton is added. So at that point, what Peterson is owing us is no longer 8 carton, but 10 carton. So at this point now, debit note has increased his indebtedness. Number 3, interest on overdue account. Peterson, when are you going to pay us? I will pay you at the end of January. Now, this is around February. Okay, now this is February. You are not able to pay. If you are not able to pay at the end of January, we are going to charge you interest because of fluctuations in monetary value. Somebody that was owing several years ago and want to pay it now, the value of that money must have reduced. So interest is important to update the value of the goods that was actually bought on credit. So at this point, interest on overdue account has come to increase the indebtedness of our debtors. And then at that point, they just have to be on the debit side. And then the next one is what we call dishonored check. Peterson brought a check. And when we took the check to the bank, we saw that the amount that was on the check was not up to his bank account balance. Peterson only have 500,000 in his account, and is giving us a check of 1 million. By the time we now took the check to the cashier looked at it and said, this check cannot be honored. Why? Because the amount that is on the check is higher than the amount that is in Peterson's account. So the check got bounced. So when a check is dishonored, it increases it. You actually made an attempt to make payment, but that payment was unsuccessful because the amount that is on the check is more than the amount that is in your account, or possibly the signatures or the signatories on the check does not tally with the signatories that is on the account. It can also make the check to be dishonored. Another thing is at the expiration of the check. Every check can last for at least 6 months. So when the check elapses at the end of this period, it becomes dishonored. So every check that is dishonored can actually increase the indebtedness of your debtors. And then the next one is discount disallowed. We actually had in mind to give you discount, Mr. Peterson, but we just decided to withhold our discount. Reasons best known to us. We actually told you to pay this money. If you are able to pay this money, assuming it is cash discount, because basically cash discount is given for prompt payment. We said, if you can pay this money by January ending, you are owing us 100,000. We are going to give you 10%. 10% of 100,000 is 10,000. So by the time you now remove 10% from 100,000, at the end of January, instead of you to pay us 100,000, pay us 90,000. Now at the end of January, Peterson is not able to pay us. What are we going to do? We disallow it. It was allowed before, but at this time, it is now disallowed. So that 10,000 that has been deducted from his debt to make it 90,000 has been added back to make it 100. So at this point, Peterson's debt is no longer 90,000, but it's now what? 100,000. The last but not the least is what we call carriage outwards. You have come to buy from our shop, and you said, we should help you transport it to the destination of your business. Probably you don't have the van, or you don't have the transportation means. We are the one making payments on the item from the destination of our business to the destination of your own business. So what do? Everything that we incur, the cost involved in transporting the item from the destination of our business to your own destination become a carriage. And since we are the one giving it out to you, it's carried outward. So it will be added to your debt. Ordinarily, you bought items worth 500,000. But in course of trying to transport this item to your business, we incur another 200K. So instead of you to pay us 500,000, you're going to pay us 700,000. So in summary, the items that you will always see on the debit side of the sales ledger control account are: number 1, credit sales; number 2, debit note issued; number 3, interest on overdue account; number 4, dishonored check; number 5, discount disallowed; number 6, carriage outward. So in a question, you can see all of these things mixed together with figures. So once you see them, identify this one and post them to the debit side. Let's now look at possible items that can now be on the credit side. What will now reduce the indebtedness of our debtors? Let's look at it. Credit side of the sales ledger control account. Possible transactions that will reduce or decrease the indebtedness of the customers include. Now, this is where I just want students to pay undivided attention. Now, we have looked at what will increase what our debtors are owing us. At this point, we want to look at what will reduce it. Number 1, cash or check from customers. Once your customer decide to pay cash, whether instrumentally or pay in full, whenever you receive that money, it's going to reduce what they are owing you. Or if they decide to bring check, like we mentioned, if the check is not bounced, the check is not dishonored, then it will also reduce what they are owing. Number 2, return inwards. Return inwards, they are basically goods returned by our customers to us because of some faults. We've sold out the items to you, and getting to your shop, you detect some faults, you detect some defect on the item. When you see defective items, you may not be able to sell them. So what do? You return it. Or some other time, the color descriptions may not suit your interest. You want to return it. So whenever that item is returned back to us, it will reduce what we were owing before. Let's go back to our normal cartons of Indomie that we have been using. And let's use our brother Peterson. Peterson has come to the shop to buy 10 cartons of Indomie. And then getting to his shop, he discovered that two cartons of some insects has actually eaten part of 2 cartons, and he can't sell it. We didn't know, he didn't know. We package everything. Getting to his shop, he now discovered that rodents or maybe insects or things has happened to that 2 bags, and then you can't sell it. What will he do? He has to return it back to us. So that 2 cartons that he returned back to us will be subtracted from the 10 that he actually bought. Now, if the 10 is 100,000 and he's returning 2 bags, 2 cartons, let's assume that each of them is 10,000. That means 20,000 will be subtracted from the 10 cartons that he bought originally. So when he wants to pay, he is going to subtract that 20,000 from his debt. So return inwards will always reduce the indebtedness of our customers. The next one is what we call bad debt. Another name for bad debt is called irrecoverable debt. Debt that cannot be recovered. Remember, there's a difference between provision for bad debt and bad debt. When provisions are made, we are trying to predict. This is basically a professional way of getting ready or preparing our mind for the raining day. Some customers can decide to die. They will buy on credit, and before the time of payment, they decide to die. And there may not be anybody to hold responsible for the item. That automatically becomes a bad debt. Or some customers can decide to go mad, go insane. When the customer is now mad, you cannot hold the customer responsible again. At that point, whatever the customer is owing you become a bad debt. Or some customers can even decide to cause problem, take you to court. And once that customer takes you to court, and then the judgment is given in his or her favor, it becomes a bad debt. So a lot of things can actually cause bad debt in business. Whenever it happens, it's going to reduce their indebtedness. And then the next one is what we call discount allow. The reduction in whatever your customers are owing you can also reduce their indebtedness. Discount allow, especially cash discount, is very, very sensitive because sometimes it's given for prompt payment. Overdue debts can be recovered through discount. Somebody has owed you for like 3 years and you are still saying, pay my debt. Why not just give the person discount? This thing has stayed for 3 years. Okay, we are owing me 1 million. Can you pay 500,000 if you can pay this year? And the person will struggle. That's about 50%. You've given him 50% discount. Pay me 500,000. The person will struggle. So whenever you give discount, that discount has reduced his indebtedness. And then the next one is what we call credit note issued. Credit note is basically for overcharge. You have overcharged your customer. You have expected your customer to pay more than he receives. This happens in 2 ways. Number one, whenever your customer return goes back to you and you have not effected that item in your book, it's automatically an overcharge. Somebody bought items worth 500,000 and returned 400 and return 100,000 worth of goods to you. By right, 500,000 minus 100,000 is 400,000. If you are still expecting the person to pay 500, it's an overcharge. Or some other time, you can package the person's item and then in course of calculation, you can overcast it, or you can overcalculate, or you can overcharge him. Whenever your customer is overcharged, you send him credit note. So credit note takes care of what? Overcharge. It's a note that is issued in favor of a customer correcting an overcharge. So that overcharge is already corrected, and then it will reduce what your customer is owing you. Then bills receivable. Bills receivable has to do with things that you have received in exchange of whatever they are owing you. You can actually receive bills, electricity bills, water bills. Different bills can come in just in exchange of what somebody is owing you. When these bills are received, it also reduces. And then the last but not the least is contra entry, or what we call set off. Like I mentioned earlier, the concept of contra entry has been dealt with in our previous videos on control accounts. Students are encouraged to go and search for control account. You will see how contra entry is explained. But for the sake of emphasis, contra entry is simply a time or a situation when your customers also become your debtors. Your debtors are also your creditors. So when your debtors are also your creditors, you have gone to buy on credit from somebody that is owing you. So when that happens, it will cancel out. So in this case now, contra entry will always be on the credit side of the debtors control account and on the debit side of the creditors control account. So in summary, the possible transactions that can reduce or decrease the indebtedness of your customers include: number one, cash or check from customers; number two, return invoice; number three, bad debt; number four, discount allowed; number five, credit note issued; number six, bills receivable; number seven, contra entry, or what we call set off, etc., etc. All right, let's quickly take something that looks like a very short illustration before we go into our exam guide. Now, if you look at this, you see a list of balances extracted from the book of Johnson. He said, the following balances appears in the books of Johnson on 1st January 1998. We have sundry debtors, 14,581. Credit balance in the sales ledger, $902. Now, the following transaction took place during the month. Bad debt written off, $627. Discount allowed, $1,593. Sales returns and allowances, $840. Bills receivable accepted, $8,351. Cash received from customers, $32,706. Credit sales, $37,906. While balance on sales ledger set off against balance in purchase ledger is $1,498. You are required to prepare sales ledger control account. At this point, we are going to make use of our white marker board. I'm going to just show us in a nutshell how to quickly represent this transaction on our sales ledger control account. I want to mention to us that we are going to be using the T method. So whenever you want to use the T method, it's a very simple process. You just write your capital T like this, your capital T, and then when you write your capital T, it is called sales ledger control account. Control account, and this is your credit side, this is your debit side. This is your dollar sign, and this is your dollar sign. This is where we call the credit side of the account, and this is where we call the debit side of the account. So on the debit side, whatever we increase what your debtors are owing us, they are the ones that should be here. And whatever we reduce what they are owing us, they are the ones to be here. Let's quickly pick now. The first one is sundry debtors. Sundry debtors, they are the amount of money they were owing us from the beginning. So you come here, your balance brought down. Your balance brought down is 14,581. That's the amount that was carried from last year into this year. Then credit balance in the sales ledger. Remember, accounts are prepared on going concern basis. It is believed that this business is not going to die in the nearest future. So we believe that transactions last year can be brought forward into this year, and transactions this year can also be brought forward into next year. So when you see credit balance in the sales ledger, what they are saying is that last year, during their payment, they had some balances. So you quickly come here and put that balance here. Balance, that's your credit balance that is also brought down here, is what? 902. That's that. Then the next transaction there is bad debt written off. Remember we said bad debt is a debt that is not recovered. So you come here, bad debt. It will reduce what they are owing you. So bad debt there is 627,000. The next one is discount allowed. Discount allowed. Discount allowed is 1,593. 1,593. 1,593. The next one is sales returns and allowance. Sales returns and allowance. Sales return, /arrow, and allowance. How much is that? It's 848. 840. And then the next one is bills receivable. Bills receivable. Bills receivable. Bills receivable is 8,351. 351. The next one is cash received from customers. You have cash. Cash received from customers is 32,706. Okay. All right. So this is bills receivable 8351. The next transaction there, after we have posted bills receivable accepted, is cash received from customers. So let's quickly put down our cash received. We're going to write C/receive. So cash/receive. Cash received from our customers is 32,706. And then the second to the last transaction there is credit sales. Now our credit sales here, our credit sales /sales, C/sales. Credit sales here is 37,906. And then the last but not the least is balance on sales ledger set off against balance in purchase ledger. This is what we call contra entry. So instead of you to write a contra entry, simply put set off, and the set off here is $1,498. Now, I want to explain something very important and sensitive on this account. I have come to discover that students can successfully post transactions into the account, but when it comes to balancing the account, it becomes a difficult thing. But in this lesson, I am going to demystify the concept. I'm going to reduce the concept in such a way that students can appreciate and understand. Now, looking at the credit side, we have the balance brought down of $902, bad debt of $627, discount allow of $1,593, S and arrow. Our S and arrow is sales return and allowance, $840. Bills receivable accepted, $8,351. Cash received, $32,706. And our set off is $1,498. Now you are going to add up everything here, and then compare them. But before we do the addition, please, I want to remind you, remember I have explained that everything that will reduce the indebtedness of our customers will be on the credit side, while things that will increase their indebtedness will be on the debit side. Please, this is our anthem. Whenever you are preparing sales ledger control account, the item is number one, everything that will reduce the indebtedness of our customers will be on the credit side. Number two, everything that will increase their indebtedness will be on the debit side. Anywhere you are, you can be reciting this until it becomes part and parcel of you. That's how to master this account, this particular account. Now, having said that, let's quickly pick our mathematical set to be able to add all the figures on the credit side. Let's start with 902. So 902 plus 627 plus 1593 plus 1593 plus 840 plus 8351 plus 32706 plus 1498. I have a total of 46,517. That's your credit is 46,517. Now let's quickly add the debit side. The debit side is just two transactions, which is 14,581, 14,581, 14,581 plus 37,906. It will give you 52,000. Your debit side is 52,487. Now the question is, how do we balance the account? Whenever you have been able to do this, you look at the one that is higher. Credit side is 46,517. $52,517, while the debit side is $52,487. By comparison, you see that 52,000 is higher than 46,000. So your total column here will go with 52,000. 52,487. 52,487. Now, how do we get our balance carried down? Our balance carried down is simply the difference between your credit and your debit. So let's quickly subtract now. 52,487 minus 46,517 minus 46,517. You are going to have 5,000. You're going to have 5,970. So this 5,970 becomes your balance carried down. So for every time you have your balance carried down, there must be a corresponding balance brought down. So your balance brought down is the same thing with this, which is 5,970. So at this point, you have completed your sales ledger control account. So this is how to prepare your sales ledger control account. At this point, this 5,970 is the amount of money that your debtors are still owing you. This is the amount, the total amount of money that they are owing you. So this is what will be taken into the next month, which is February 1998, to begin that month. By the time this is taken to that, it will now come on the debit side for the account that will be prepared in that particular month. All right, having said that, let's quickly now go into our exam guide. We quickly go into our exam guide to see if we'll be able to solve one or two other questions to further explain what we have done so far. Like I said before, I encourage students to always go to the exam guide. Always go to the exam guide and ensure that when you go to the exam guide, solve as many questions as possible. Accounting is all about practice. It is not something you can cram. As we have done in this lesson, you may not be able to cram everything. You must always go to the exam guide to solve questions. If there are areas you are finding difficult, you go back to the lesson for direction. Now we have question 1 here already. We have up to 40 questions here. We are not going to take or just pick one or two questions, and then we encourage you to take time to ensure you go through all the questions, and if you have any challenge, you go back to the lesson. Question 1. The balance in a sales ledger control account indicates the dash: total purchases, total debtors, total sales, difference between debtors and creditors. The balance in the sales ledger control account indicates total purchases. It cannot be total purchase because what we are dealing with here is sales. So that one is out. It cannot be total debt. It cannot be total debtors. Okay, it cannot be different between debtors and creditors because you can't have both of them on this account. So the answer is between total debtors and total sales. Remember, the name of this account is called Total Debtors Control Account. Total Debtors Control Account. So anything that look like debtors, anything that look like balance here falls on total debtors. So total debtors, option B, is the answer. Let's look at question 2. All right, question 2, we have used the following information to answer the questions. Debtors Control Account. We have our balance brought down, which is 800, and then we have, which is bank, then we have discount. We have discount is, our discount is 200, and then our balance carried down is 3,000. The closing balance is a dash. Okay, now let's look at it. The balance brought down is 8,000. Our discount is 200. And then our balance carried down is 3,000. We have a column where they have X is for 12,000, and then we have bank is for Y. This question is meant to be a continuation of another question. Use the following information to answer the questions. Abu, a debtor to Dahlia, owed 10,500 at the start of the month. He paid 40,005 during the month and received additional credit sales of this. Abu's balance at the end of the month is, this one is a very straightforward question which we are quickly going to look at. Let's quickly look at this question and see how we'll be able to use it to explain what we have said so far. All right. Abu is a debtor to Dahlia. So Dahlia to Dahlia. He owed 10,000 at the start of the month. Remember, Abu is a debtor to Dahlia. He owed Dahlia 10,000 at the beginning. So if we want to draw our account here, at the beginning, our balance brought down is 10,500, 10,500 at the beginning. He paid cash of 40,000, so you come here and write cash. The cash that is paid here is 40,000, 1, 2, and 5. During the month, and receive additional credit sales. Additional credit sales of, so your credit sales here is 20,000. 20,000. Okay. So Abu's balance at the end of the month is simple. Abu's balance at the end of the month is what? Let's look at it now. This is it. First of all, here is already higher than here because here is 40,005. Why here is what? This is your credit side. This is your debit side. Now, this is your sales ledger account. Now, this side, credit side, is equal to 40,000. While debit side is equal to what? 30,500. 30,500. So here is higher than here. So you come here, write your 40,005. Now, when you subtract them, your balance carried down is going to be on this side. So let's quickly subtract now. Subtract 40,500. Subtract 30,500 from 40,005. You are going to have 9,000. So you have 9,505. This is what we call credit balance. So your 9,505 is credit balance. It's going to be credit balance because this is what will be added to the debit side to be equal to the credit side. So the credit side is more than the debit side with 9,505. So let's look at the answer here. Option A is 30,500 credit. Option B, 8,505 credit. Option C, 30,505 credit. Option C, 9,505 credit. So our answer here is D, 9,505 credit. Let's take the last question. This is a continuation of another question. Let's take a fresh question. Okay, use the following information. Abu, a debtor to, we've already solved this. We've already solved this. Okay, sales ledger balance, 31st, okay. Total for the month cash sales, returns, check dishonored. Okay, let's quickly look at this and then we end the session. All right. It said sales ledger balance. The sales ledger balance from the beginning is this, and then at the end is this. So you quickly bring your sales ledger. This is your sales ledger account. This is your credit side and this is your debit side. Your opening balance is always your balance brought down, which is 9,000. And then your balance at the end is what? 30,000. It's 30,000. Now, total for the month, cash sales. Remember, when we are talking about this, there is no place for cash sales in sales ledger account. That's one thing students must also understand. The examiner will always bring in cash sales to confuse you. Cash sales will be posted to the what? To the cash book. So cash sales is out. We have return inwards. Your return inwards here is 3,000. And then your dishonored check, you have dishonored check. Dishonored check is 4,000. Dishonored check is 4,000. So when you add everything here, you have, this is 30,000, that's 37,000, and then your balance carried down. Your balance carried down here is going to give you 37,000 minus 9,000. 37,000 minus 9,000, 37,000 minus 9,000, we give you 28,000. To give you 28,000, it will give you 28,000. So this is 28,000 that is going to give you. So what they are asking you now is, what is your total sales? Your total sales for the month. Your total sales for the month is basically your credit sales plus your cash sales. Now, the cash sales in the question is 10,000. The cash sales in the question is 10,000. So we've already calculated 28,000 to be our credit sales. So our credit sales here, this is going to be our credit sales. Our credit sales here. Credit sales here. Credit sales here is going to be 28,000. Your return invoice is 3,000. Okay. Return invoice is 3,000. Let us reframe this solution again. Let's reframe the solution again. Dishonored check is one of the items that must be on the debit side. We have said that when checks are dishonored, it's going to be on the debit side. So dishonored check will be on the debit side, which is 4,000. And then you now add. Your dishonored check is on the debit side, while return invoice is here. Then your balance carried down is 30,000. So you are going to have 33,000. You have 33,000. So 33,000 minus 11,000. 33,000 minus 13,000. Minus 13,000. 33,000 minus 13,000. It will give you 20,000. So your credit sales is 20,000. It's going to give you 20,000. So your total sales for the period, total sales is equal to credit sales plus cash sales, which is equal to credit sales is 20,000 Credit sales is 20,000 plus your cash sales is given in the question, which is 10,000. So the answer is 30,000. So 30,000 is the answer. Let's look at the options. The options here, number A is 31,000, B 30,000, C 36,000, D 20,000. So the answer here is B. All right. So I encourage students once again to always go through our exam guide to solve as many questions as possible. You can see the way it is now. Initially, I posted this dishonor check on the credit side. Before I now remember that you cannot post dishonor check on the credit side because dishonor check is something that must increase what your debtors are owing you. They paid through check, but that check was dishonored. So that check must be on the debit side. Don't always forget. What will be on the credit side are the transactions that will reduce their indebtedness. Okay, so far, that is how far we can go.